So this pretty picture here is of the Imperial Palace in Tokyo. I'm sure most of you would have heard a story, and it's a bit of quite a nice story actually, of the Imperial Palace being worth the same as all the real estate of California during the property boom in the late 80s. So it's a bit of an odd claim to make. I never saw a kind of for sale sign on the palace's doors. But what was interesting at the time, you had a property boom where office property real estate in the middle of Tokyo, so in Ginza, the CBD business district, was selling for up to $1.5 million a square meter. So you had not rands or yen, it was $1.5 million per square meter was being sold during the property boom of Japan. Using those figures, and that's how the whole story came together, this palace's grounds was worth more than California's real estate, but also it equated to roughly $5 trillion at the time, which if you looked at Japanese's GDP at the time was $5.3 trillion. So it's just an extraordinary kind of backdrop to what's happened there. If you go a bit further back, the country obviously enjoyed pretty good economic growth from kind of the end of World War II to the end of the Cold War, and then from the period from 86 to 91, including this period I just talked about, animal spirits took over and credit extension in the market exploded, which led to a tripling ultimately of equity prices and home prices. Now, if you take a step further, I mean, you all know the crisis that happened afterwards, the bubble that burst, as most bubbles ultimately do. Now, if you put yourself into the shoes of a banker, and you were that sucker who lent kind of money to people to acquire $1.5 million office property, you can imagine that it wasn't a pretty picture for financial companies in Japan post the crisis. And to kind of say that they experienced an issue in the loan books is a bit of an understatement. Now, obviously, the crisis that followed led to many years of deflation and low inflation, which resulted in, now this is the Japanese 10-year government bond, it resulted in many years of falling bond yields, which over the last 20 years have remained below 2% kind of since 1998. Over the last 2 years, we've seen the Bank of Japan aggressively buying government bonds in unlimited quantities, depressing yields even further and trading near zero and even below 0%. So if you're a bank or insurance company, not only did you see your kind of balance sheets being obliterated through the crisis, but also your earnings from low interest rates, which ultimately resulted in share prices in the banking space, the black line being the TOPIX 100 index. It's down 88% since 1990 in yen terms, or 84% in dollar terms. So that combination of low valuations we're seeing in Japan, low earnings that have been kind of squeezed from low interest rates, and also fixed up balance sheets, in our view, offers a lot of upside, even if nothing changes. What we've also done is we've obviously considered what any marginal change in the yield curve control by the Bank of Japan would mean for earnings, and there's significant leverage to any marginal change in the shape of the yield curve. So our base cases and bull cases offer a lot of asymmetry to the upside. So a lot of people in the market, and that's obviously why it's uncrowded, still think of Japanese financials as being the kind of perennial value trap to be kind of doomed forever. We do think it's a very low, or one of the least crowded areas globally, cleaned up, but also a great diversifier, and potentially one of the world's cheapest kind of options on any interest rate normalization.